Hey everyone, let's talk about investing. It can seem intimidating, but it doesn't have to be. Today we're diving into a classic book called The Intelligent Investor by Benjamin Graham. Think of it as your roadmap to building wealth in the stock market. This book is like having a wise mentor guiding you, even if you're just starting out. We'll break down the big ideas into bite-sized pieces you can actually use. Get ready to become a smarter investor. We'll explore key concepts like finding undervalued companies, the power of patience, and how to protect your money. By the end, you'll feel more confident about making smart investment choices. So, grab your favorite drink, get comfy, and let's unlock the secrets to becoming an intelligent investor. Imagine being able to buy $1 for 50 cents. Sounds great, right? This is the essence of value investing, a strategy that has been employed by some of the most successful investors in history. It's a method that requires patience, diligence, and a keen eye for detail. That's the basic idea behind value investing. It's not about following the crowd or jumping on the latest trend. Instead, it's about doing your homework and finding those opportunities that others might have missed. It's about finding companies that are worth more than their current price. These companies often have strong fundamentals, such as solid earnings, a robust business model, and a competitive edge in their industry. Think of it like treasure hunting. Just as a treasure hunter uses a map and a metal detector to find hidden riches, a value investor uses financial analysis and market research to uncover undervalued stocks. You're looking for those hidden gems the market might be overlooking. These gems are often hidden in plain sight, but it takes a discerning eye to spot them. These companies might be undervalued because of temporary setbacks, or simply because investors haven't noticed their potential yet. For instance, a company might have experienced a short-term dip in earnings due to an economic downturn, but its long-term prospects remain strong. Value investors look beyond the hype and focus on a company's true worth. They don't get swayed by market noise or short-term fluctuations. Instead, they dig deep into a company's financials, management team, and competitive position. They analyze financial statements, assess the strength of the business, and determine if it's trading at a discount. This involves looking at metrics such as the price-to-earnings ratio, price-to-book ratio, and free cash flow. Remember, patience is key. It might take time for the market to recognize the true value of these companies, but that's where the opportunity lies. By getting in early, you can benefit from the eventual price appreciation as the market catches on. But when it does, you'll be glad you invested wisely. The rewards of value investing can be substantial, but they require a disciplined approach and a long-term perspective. So, keep your eyes open, do your research, and you might just find the next hidden gem. In the world of investing, patience isn't just a virtue, it's your secret weapon. The intelligent investor emphasizes the importance of long-term thinking. Instead of trying to get rich quick, which rarely works, focus on steady, sustainable growth over time. This means riding out the market's ups and downs and staying committed to your investment strategy. Think of it like planting a tree. You wouldn't expect it to grow into a mighty oak overnight, would you? It takes time, nourishment, and care for it to reach its full potential. The same goes for your investments. By investing for the long haul, you give your money the time it needs to grow and compound, leading to potentially significant returns over time. Section 4. Investing versus speculation. Playing it safe. Now let's talk about the difference between investing and speculation. This is a fundamental concept that every aspiring investor must grasp to navigate the financial markets successfully. Understanding this distinction can be the difference between building long-term wealth and facing potential financial ruin. It's crucial to understand this distinction to make smart financial decisions. When you invest, you are essentially putting your money to work for you, with the expectation that it will grow over time. This involves a careful analysis of the assets you are purchasing, whether they are stocks, bonds, or other investment vehicles. Investing is like building a house on a solid foundation. Just as a house needs a strong base to stand the test of time, your investments need a solid foundation of research and understanding. This means looking into the financial health of the companies you are investing in, understanding their business models, and assessing their long-term growth potential. You're buying a piece of a company through stocks. When you purchase shares, you become a part owner of that company, entitled to a portion of its profits and assets. This ownership stake can appreciate in value over time, especially if the company performs well and grows, or lending money through bonds. Bonds are essentially loans that you give to companies or governments, which they promise to pay back with interest. This can provide a steady stream of income and is generally considered less risky than stocks, although the returns may also be lower, with the expectation of earning a return over the long term. The key here is patience and a long-term perspective. Successful investing is not about making quick profits, but about building wealth gradually over time. This requires discipline, research, and a clear understanding of your financial goals. Speculation, on the other hand, is more like gambling. It involves making high-risk bets on the short-term movements of asset prices, often without a thorough understanding of the underlying fundamentals. This can be exciting and potentially lucrative, but it also comes with a high risk of loss. It's trying to predict short-term price movements. Speculators often rely on market trends, technical analysis, and even rumors to make their decisions. While some may succeed, many others end up losing significant amounts of money because the market can be unpredictable and volatile, in the hope of making a quick profit. The allure of quick gains can be tempting, but it's important to remember that with high potential rewards come high risks. Many speculators experience significant highs and lows, which can be emotionally and financially draining. This often involves high risk. Speculative investments can be highly volatile, and their prices can swing dramatically in a short period. This unpredictability can lead to substantial financial losses, especially if you are not prepared for the market's ups and downs, and can lead to significant losses. Many people who engage in speculative trading without proper knowledge or strategy end up losing more than they gain. It's a high-stakes game that can be unforgiving to those who are not well prepared. The intelligent investor encourages you to be a prudent investor, not a reckless speculator. Focus on sound businesses, ones with strong fundamentals and a proven track record. This approach minimizes risk and increases the likelihood of achieving your financial goals. Understand what you're investing in. Take the time to research and understand the assets you are buying. This means looking beyond the headlines and hype and digging into the financial statements, management team, and competitive landscape of the companies you are considering. And don't get caught up in market hype or risky bets. The stock market can be influenced by emotions and short-term events, but successful investing requires a calm and rational approach. Stick to your investment plan, stay informed, and avoid the temptation to chase after the latest trends or speculative opportunities. Section 5. Margin of safety, your financial cushion. Imagine buying a car with a built-in safety feature that protects you in case of an accident. This feature is designed to minimize the impact and ensure your safety, even in the worst-case scenario. Just as you wouldn't drive a car without airbags, you shouldn't invest without a margin of safety. That's what margin of safety is all about in investing. It's a principle that helps investors make decisions that protect their capital. By ensuring that you buy assets at a price lower than their intrinsic value, you create a cushion that can absorb potential losses. It means buying stocks at a price significantly lower than their intrinsic value. This approach is not just about getting a good deal. It's about building a protective barrier around your investments. When you purchase stocks at a discount, you give yourself a better chance to weather market volatility. This discount acts as a buffer, protecting your investment if things don't go as planned. Think of it as a financial safety net that catches you if you fall. By having this margin, you can sleep better at night, knowing that your investments have a built-in layer of protection. Think of it like this. If you estimate a company's worth to be $100 per share, you might aim to buy it for $70 or less. This way, even if the company's value drops, you have a cushion that can absorb some of the impact. This strategy is particularly useful in uncertain markets. This 30% discount provides a margin of safety, reducing your risk if the market takes a downturn. Market fluctuations are inevitable, but with a margin of safety, you are better prepared to handle these changes without significant losses. It's like having a shock absorber for your investments. By incorporating a margin of safety into your investment decisions, you're essentially buying insurance for your portfolio, protecting yourself from potential losses. This approach not only safeguards your capital, but also allows you to take advantage of market opportunities with greater confidence. In the long run, a margin of safety can be the difference between a successful investment strategy and one that fails to meet your financial goals.